What's up, everybody? This is another video that most of you guys have been requesting, is video on risk management that you can use to prevent your accounts from blowing. Now, I know there's been a lot of demand for this kind of video from you guys in the comment section down below. You've been asking me how you can prevent yourself from blowing your accounts, how you can use your stop loss correctly and profit from the market instead of having to blow your account all of the time or every month and then having to deposit more money onto your account. In today's video, I am going to show you guys how you can use risk management to prevent your account from blowing, and I hope you guys will appreciate the content by subscribing to the channel and also going to join the links that are in the description of this video. Go and join the free Telegram that I have in the description down below, and also you can join the paid or the VIP signals channel. It is also linked within the free Telegram channel. So without wasting any more time, let me take you guys onto the charts so that I can show you guys how you can be able to trade successfully using proper risk management. I am going to show you guys all of the procedures that you need to take or need to follow as you are trading this kind of way. Let's go onto the charts right now. What I'm going to show you about risk management could be a life-changing or a life-saving moment for you if you are struggling to keep your account, however small your account is. Watch this video until the very end and do not skip at any one given moment, because what you're going to see here could mean the difference between you becoming successful and you continuing to lose in Forex or continue to blow your accounts. Now, risk management comes in many ways, okay? Risk management can come in position sizing. Risk management can come in form of stop loss and take profit levels. Risk management can come in form of indicators or based on indicator values. It can also come based on market sentiment. It can also come based on time frames that you're trading. Let's say you're a day trader, you're a swing trader, you're a scalper, you're a position trader. So risk management revolves around many factors, and it is varied according to which type of trades you are taking, what type of trader you are, the season, the sentiment of the market, the time frames, the indicator values, that's if you're using indicators determine your stop loss, and many others. But in today's video, I just want to show you a few ways that you can be able to protect your account from blowing and preserve your capital for you to be able to continue trading or trade another day. Okay, so here we are on the gold chart. This is a gold 1 hour chart. So what we are going to do here is we are going to use market structure levels to determine how we can do our risk management using stop loss placements based on market structure within the market. Okay, so what you do when you're trading, let's give an example of $100. Okay, let's give an example of $100. With $100, you have to determine how much you are willing to lose per trade based on how fast you want to grow the account or what your risk appetite is. But as you do this, keep in mind that if you choose a higher risk percentage per trade on your account, it means that you have a very small sample size for you to be able to either grow or blow that account. For example, if you choose 10% risk per trade, you only have 10 trades as a sample size for you to be able to grow your account, double it, triple it, or blow your account within 10 losing trades. So you choose that carefully based on your risk appetite. But the rule of thumb, or what most of the professional traders that I know or successful traders that I know use, is they use a risk parameter of 2% on their account. I've seen some who use 5%, but those are the really good ones who don't lose often. Okay, So how do you determine your risk per trade? You determine your risk based on market structure. Now let me show you what I mean. What I mean is this. For example, here, let's just use this part randomly. You're here and you see, for example, that there is this structure here. Okay, market is creating that structure here. Okay, market has created this structure, right? Now, when you look at this, most of the strategies, if not all the strategies that based on market structure, will tell you that this area here is an area of supply. Okay, they'll tell you this is an area of supply. It's not accurate. I'm not drawing this accurately. I'm just drawing it to show you how you could manage your risk. Okay, so you would see that this is an area of supply, for example. So how do you determine your risk here or your stop loss placement here? For example, you've determined that you're going to be risking, say, 5% of your account. Now, how do you determine your stop loss here? Or how do you determine the level where you're going to place your stop loss and your take profit? You determine that based on this market structure here. Okay. So before you place the trade, for example, you would say, let me put limit order here so that when prices back up, you can be tagged into the trade. And where is, which position, if you just look at this chart, which position would you naturally gravitate towards putting your stop loss? Of course, you will see that your stop loss has to be a few pips above this high, above the supply zone. Let's say a few pips above, like that. So just this structure here has allowed you to determine your stop loss placement. So after you've determined stop loss placement, after you've determined the risk percentage you're going to take, let's say 5% of your account, you now determine your stop loss placement based on this market structure. You see here, you say now, okay, I am risking 94 pips on gold. Okay, I'm risking 94 pips on gold. Or you can even say, let me risk 90 pips, like that. Let me risk 90 pips on gold to get, to do like a 1 to 2. Okay, let's say you want to do a 1 to 2. 1 to 2. Let's do this one for a 1 to 2. Okay, so this trade wins. Why does this trade win? I know some of you may say you're doing this in hindsight. Yes, doing this in hindsight because I want to show you how you can do your placements. Why did I choose this area? I chose this area based on market structure because I see that there is another structure level right here. Okay, so that is where I have chosen to put my take profit because I believe price would come to price into this level, which you could call a level of demand. Okay, so that is a method that you can use to determine your stop loss placement after you have decided what risk you're going to take on your account. For example, 2%, 3%, 5%. Okay, after you've decided the risk you're going to take per trade, okay, then you come and look at the market structure levels where you can use to determine your take profit and your stop loss. But after you have determined your stop loss first, you've seen the pips, then you can calculate your percentage risk or calculate your lot size. Okay, you calculate your lot size based on the percentage risk that you determined in the beginning, for example, 5%, and then also based off of these pips here. Okay, so you use the market structure levels to determine your entry points based on the percentage you've determined for your risk, and then you use the market structure levels to determine your take profit levels. Okay, so that is how you determine your risk per trade and determine also your position sizing based off of market structure after you've determined the placement of your stop loss and risk. Okay, so that is one thing. The other way that you can do your risk management or determine your stop loss placement, stop loss or take profit placement is you determine that based off of news events. Okay, based on news events. For example, if you're going to take a trade here, let's assume you want to take a trade around this area because, of course, you've seen, let me just take this. Here, you've seen, for example, that there is this level here, it extends, okay? So let's assume the price is here, okay? Price is here and you want to take your trade. But a few hours, like 4 to 5 hours, in like say in the afternoon, you know that there is news events going to happen. And you know that a news event can go either bullish or bearish, okay? But you see that there is this structure. So what you do is you determine your entry here based on the news that's going to happen, for example, in the afternoon, high impact news. And then, for example, you've determined that this area here has been rejected multiple times. So you think, according to your analysis, that the market could push to the upside, okay? So for example, you entered your trade after this bullish engulfing here, entered your trade here. Your stop loss placement is below this level of structure, which is not demand. Now this is support, okay? This is support. So you enter your trade there, place your stop loss here, which would be 96 pips or 95, even 90. Yeah, 90 pips on gold, 90 pips here. And then what will your take profit level be? What will your take profit level be? You see that this level here still, see this level here? This level here can be your take profit, the highest point. You see this point from this side here? You see that there's a level from this side, that's the highest point, okay? You put your take profit level right there. So you pull this up to there, which would give you still a 1-to-2 risk to reward ratio. So you determined your take profit based on the previous level of structure. You determined your stop loss based on the previous level of structure. And you determined to hold your trade into profit even when you know that the news is going to happen, based on the fact that you've entered here on the level of structure. So the news just gives you a confirmation for direction, okay? But your take profit and stop loss are determined by the levels, okay? So that's the other way. Use the economic calendar to determine whether you can hold your trade into take profit or you don't enter that trade if your entry is not at a key level. So that's another way you can determine your stops. Now, there are other ways you can determine, which I may go over in another video because I don't want to make this too long. But you can also use market sentiment to determine your risk, how much you're going to risk for a given trade. If the sentiment is largely bearish, for example, if the majority of the people are selling the market, you know, of course, that will drive the price in the opposite direction. If many people are buying something, most of the time, the institutions and the large players are going in the opposite direction. So, for example, if you see that at around this area, let's say here, you say here, there's this aggressive selling here, you determine that, okay, this aggressive selling here is to induce sellers to come into the market. So, of course, you will find that many people will start to sell from this area, then the market pulls back against them, then they continue to sell. At this point here, the sentiment is bearish, so the market will continue bearish for some time with occasional bullish moves like this, just to stop out sellers, okay? But at this point here, there is an accumulation happening. The banks and large institutions are accumulating around here. So that's what you would be looking for, buy trades, the opposite to the sentiment. So you can see that from here, the market reverses and goes up because there is a bearish sentiment here. Here, the banks and large institutions are accumulating positions to drive the price higher, okay? So you use sentiment also to determine your risk and direction of the trade. How do you determine your stop loss based on sentiment? You use the levels that are being created by the big players, okay? Their footprint. For example, these retracements here, you see these retracements. Those retracements there give you a confirmation on where you are supposed to start entering buy trades to accumulate positions. Now, you're asking me a question. Where do I determine, or where do I enter the trades for a buy? Now, this is where you enter. Okay? Wait for one of these legs or one of these highs to be taken out. You can see, wait for these highs to be taken out. So this is the high that is taken out. I showed you this before on this channel. I showed you this using a strategy for smart money concepts, which I'll leave at the end of this video for you to go watch. So you see this high is taken out by these bullish candles here, inducing people to jump in for buys here. So when people jump in for buys here, the large institutions will price lower to get to get into this gold buys at a cheaper price. So after this retracement below this previous high, which was taken out, when they retrace to this below this level, that is where you start looking for signs for you to buy. For example, you will find that you will get 3 white soldiers here, you get 3 white soldiers here. For example, if we entered the 3 white soldiers here, if we entered here, okay, where would we place our stop loss based on the current sentiment? Because the sentiment here is people are now selling here because of these candles. So the sentiment changes to bullish. So where do you put your stop loss? Your stop loss is below the low, or at the low which created the high that was taken out. This is the high that was taken out, okay? Where is the low that created this high? It is this one here. So that is where you place your stop. I think you can see here, okay? This is the low. Let me show you that clearly here. This is the low that created that high, okay? So that is where you put your stop loss. And then you will target that high, or you will target a 1 to 2. Whatever you want to do, you target a 1 to 2 based on what reward you're looking for. So that's how you use the sentiment to determine your stop loss placement and also your targets based on your risk. Now, when you do this, guys, as you do this, keep in mind that you have to use a strategy here. Here, I've shown you like two strategies. I've shown you strategy on demand and supply. I've shown you strategy on break of structure using market makers model and also smart money concepts here. So I've used the 2 strategies here. Okay. So guys, don't want to make the video too long. I hope you guys try out this to help you with your risk management. And remember, use not more than 5% of your account. Okay. Don't risk more than 5%. But try to backtest what I've shown you here when you're taking trades. It will help you to place your stop loss better and also get better moves within the market. So guys, I hope that helps you out with your risk management. If this has helped you, please don't leave the video without subscribing to the channel, liking this video so that YouTube can show it to more traders who are like you. And also be sure to join the Telegram channel, links in the description down below. Thank you guys for watching. Until next time, peace and out.